Hi everyone, welcome to another lending update with David. This is for June 2019. So the most exciting news this time is RBA have actually slashed their cash rate from 1.5% to 1.25%. They haven't changed that cash rate for over 2 years now, or even longer. I think it's actually good to be able to see that RBA is obviously slashing cash rate in order to improve the consumer confidence. And as a consequence of that, most of the banks have actually now passed on those cuts too. So I'm not going to outline all the banks that have passed the rate, but I can tell you most of the lenders have actually passed somewhere in between 0.19 to 0.25, and that can consist of fairly significant savings for each family, which means everyone will have a bit more money in your pocket in order to improve consumer spending. So which is a great outcome for all the end customers. So it's actually a good time at the moment to review your interest rate, I would say. If you are on variable, just keep an eye out on what you're currently paying, as there are some very competitive ones on the market. And if you are looking at fixing, my suggestion is actually hold off on that for the time being, because there could be another 0.25 cash rate reduction further this year. The other exciting news this month is in relation to APRA, the Prudential Regulatory Authority, now looking at reviewing the assessment rates in terms of how much people can lend. So for those who don't know, basically the assessment rate is how lenders assess your repayment capability for a loan. And usually that's being set at 7.25 for a long period of time. Why 7.25? Because traditionally 7.25 seems to be the average median across the last 20 years. So that's why banks have taken the conservative approach, even though at the moment, most consumers are paying somewhere around the 3 point something to 4 point something. They've actually are still using 7.25% as the actual assessment rate. So the easiest way to understand that is, let's say for example, you're taking out a new mortgage, and that mortgage, how lenders look at it is they look at your repayment per month at 7.25% across the time you're actually paying off the principal. So as you can imagine, that's actually quite significant in terms of the repayment number or the monthly repayment figure. So people have been arguing, or there's a lot of public voices in relation to that, to say we actually need to review that. Because the interest rate, we're currently in a low interest rate environment, and it seems like the RBA just dropped their cash rate, and it seems like the low interest rate environment will be here for a while. So it does not make sense to have such a big gap between what the consumer actually pays as to what the old assessment rate is. So APRA is currently in process of reviewing that, and there's been some positive news about what that will be. And we don't know how we still haven't got clarity around the exact details yet, but at high level, I think there might be some changes where owner occupiers, so in other words, people looking at buy your own home, will be able to be assessed at a lower assessment rate, whereas property investors, unfortunately, especially the high risk property investors looking at borrowing in interest only, unfortunately, they might still be assessed at 7% or even higher. So look, at this point, we have not much more details to be able to inform everyone, but I reckon sometime next month or even in September, as APRA goes through these review processes, we'll have further updates to come. So there you go. There's our lending update for June 2019. We hope you like this series, and as always, if there's any further updates, I will make sure that everyone's informed. And if you like this video, please make sure that you like it, share it with your friends, or make a comment below on how we can actually improve further. Until next month, I'm Dave from lendpower. We'll see you in another month's lending update with David.